Hi there. Thinking about transferring trading company shares into a family trust? Here's how CGT holdover relief may apply.
When a successful UK founder transfers 30% of their £2 million trading company into a family trust, it's a major step in securing their legacy. HMRC's deemed disposal rules treat this transfer exactly like a sale at full market value, regardless of whether any money actually changes hands. This triggers an immediate capital gains tax liability on the increased value of those shares. Because the founder receives £0 in cash from the gift, they're hit with a dry tax charge that must be paid from other liquid resources. The pressure to act is mounting. With the new £2.5 million business property relief caps arriving in April 2026, many founders are moving to execute these transfers under the current, more favorable rules. Atlas tax advisors act as the specialized guides through this process, navigating the specific intersection of UK trust law and capital gains tax. Preserving family wealth depends on selecting the specific statutory relief that can neutralize this dry tax charge before the transfer takes place. Two primary routes exist for deferring this tax: Section 165 for business assets and Section 260 for transfers that trigger an immediate inheritance tax charge. Since settling shares into a discretionary family trust is a chargeable lifetime transfer for inheritance tax purposes, it falls directly into the scope of Section 260. Statutory ordering rules dictate that if a transfer qualifies for both, Section 260 takes legal priority over Section 165. Utilizing Section 260 through a trust transfer provides structural advantages for the company's non-trading assets that a direct gift to an individual cannot provide. Imagine a company where 75% of the value comes from core trading operations, but the remaining 25% is held in passive investment properties. A standard Section 165 claim enforces a proportional restriction. It isolates those non-trading assets and triggers an immediate capital gains tax bill on that 25% investment portion, even if the company is classified as a trading entity overall. Section 260 does not use this proportional restriction. It allows the entire gain on the shares to be held over, deferring the tax on the investment assets alongside the core trading operations. For owners with diversified business interests, Section 260 acts as a structural bypass, protecting the estate from tax leakage during the succession process. While Section 260 defers the capital gains tax, business property relief must be applied to eliminate the 20% inheritance tax entry charge on the trust transfer. To qualify, the company must meet the trading company test, meaning its activities do not include non-trading activities to a substantial extent. In the case of Assam Alam, the upper tribunal moved away from HMRC's rigid 20% mathematical threshold. Instead, the substantial test is now a qualitative assessment that looks at the company's history, expenses, and staff time as a whole. This means a company can hold investment assets and pass tax-free into a trust, as long as its dominant characteristic identity is a trading business. This strategy fails if you fall into the settler-interested trap. If the founder, their spouse, or their minor children can benefit from the trust in any way, Section 260 relief is denied entirely. There is also the emigration trap. If the trustees or beneficiaries cease to be UK residents too soon after the gift, the tax benefits are lost. If the trustees leave the UK within 6 years of the end of the tax year in which the gift was made, a clawback is triggered. The deferred gain crystallizes immediately, and the trust becomes liable for the full tax bill. This mechanism defers the gain by reducing the trust's base cost in the shares. If the trust structure fails the residency or settler interest tests, that deferral is lost. To claim the relief, both the founder and the trustees must jointly sign HMRC Form HS-295. The claim must be submitted within 4 years of the end of the tax year in which the shares were transferred. With the April 2026 changes to business property relief approaching, the window to use these existing thresholds for succession planning is narrowing. This information is general guidance for the 2026 to 2027 tax year. Always seek personalized professional advice for your specific circumstances. Mastering these overlapping rules is the key to protecting a business legacy. To begin your succession strategy, contact Atlas Tax Advisors via the link in the description.